Thank you for joining us at XM.com. This is today's Daily Market Comment by Haralambos Pisuros. I'm Christina Marujos. The U.S. dollar traded lower against most of its major peers on Wednesday and continued drifting south today as well. It seems that with the ongoing uncertainty surrounding the world's biggest economy, traders are finding it hard to trust the greenback as a safe haven. Yesterday, the U.S. House of Representatives narrowly passed a bill to raise the government debt ceiling. The bill is not expected to pass the Senate, and President Biden said he would veto it if it did. On top of that, U.S. government officials said that they will not intervene to save the First Republic Bank, leaving investors on the edge of their seats in anticipation of whether the bank can find buyers for its assets. As if all of this was not enough to upset dollar traders, the Atlanta Fed GDP Now estimate for Q1 GDP was revised sharply down to 1.1% quarter over quarter, which shifts the risk surrounding today's official GDP data to the downside. The data is expected to show that the U.S. economy grew 2% in the first 3 months of 2023, but a disappointment in today's data could keep the dollar under pressure. Even if the data surprises to the upside, Fed rate cut bets are unlikely to vanish, and any dollar recovery may remain limited and short-lived. With the European Central Bank expected to increase rates by another 75 basis points this year, Euro-dollar may be poised to continue drifting north for a while longer. The Bank of Japan will announce its policy decision tonight, the first under Kazuo Ueda's leadership, where no policy change is expected, but investors may be on the lookout for clues and hints on when and what kind of tightening the bank could deliver in the coming months. Anything suggesting that the bank will stay the course through the summer may disappoint those expecting some action and thereby hurt the yen. In the equity sphere, the anxiety continued to weigh on the Dow Jones and S&P 500, with both indices ending another day in the red. However, the Nasdaq gained nearly 0.5%. Although the tech-heavy index was boosted by a jump in tech stocks, the others were pulled lower by weakness in economically sensitive sectors such as industrials. That said, with the Fed expected to cut rates later this year and the bar for the earnings season being set so low, any further declines in equities could stay in check. Oil prices dropped by almost 4% yesterday, despite data revealing that U.S. crude inventories fell more than expected last week. This highlights that investors are more concerned about the likelihood of a potential recession, which could dent future fuel demand, despite signs of improvement in the short run. Thank you for watching today's Daily Market Comment here at XM.com.